What you're seeing right now in silver is not a normal rally. This is not momentum traders chasing a chart. This is not a technical breakout driven by algorithms alone. And it is definitely not speculation. What just happened at 75.60 is something very different. This is the ignition of a war premium. And it marks the beginning of a new phase in the silver bull market. A phase where resistance doesn't fade gradually, it snaps. Let's set the stage. For months, years really, silver was held down by the same familiar forces. Paper leverage, coordinated short pressure, regulatory games, and narrative control. Every rally was capped, every breakout was sold, every bullish development was dismissed. Until now. Because this move didn't start with traders. It started with geopolitics. Force number 1, the war premium has arrived. Over the weekend, the United States launched a military operation tied to Venezuela. Call it enforcement. Call it sanctions. Call it geopolitics. Markets understood it for what it really was, a resource signal. Whenever a major power moves militarily around energy or commodities, the message is unmistakable. Secure supply now. That single realization changes everything, because capital doesn't wait for clarity, it reacts to risk. And the moment that risk appears, money moves instantly into assets that cannot be printed, frozen, or diluted. Gold surged, but silver did something more important. Silver surged as both. A monetary safe haven. A critical industrial input for weapons systems, satellites, electronics, and defense infrastructure. Silver is not just money. Silver is a weapon metal, and the market repriced it accordingly. This is why silver didn't grind higher. It gapped. Liquidity vanished at the open. Short sellers didn't get a chance to adjust. They were trapped. That gap wasn't enthusiasm. It was absence of sellers. And when sellers disappear in a leveraged market, price doesn't negotiate. It jumps. Force almost 2. The Shanghai vacuum is still pulling. Now here, Ness, where the story becomes structural. The silver exploded higher in New York to around 75.60. Shanghai was already trading above $80. That gap didn't close. It widened. And that matters more than any headline. Because Shanghai is not a paper playground, Shanghai is a physical market. Contracts there are bought to secure metal for factories, solar lines, EV production, electronics, and infrastructure. This is real demand, and it is price insensitive. Here is what S happening behind the scenes. Arbitrage systems and industrial buyers are continuously buying silver in the West and shipping it east. Not because they love trading, but because they must secure supply. That creates a one-way flow. Metal leaves New York. Metal leaves London. Metal disappears from Western vaults. And here, as the key point most people miss, COMEX does not set the global price anymore, it defends it. Shanghai sets the demand. COMEX reacts, or it gets drained. As long as that Shanghai premium exists, Western prices are under constant upward pressure. Every dollar difference is an incentive to pull physical metal out of the West. The only way to stop that drain is higher prices. This isn't speculation, it's logistics, and logistics always win. Force number 3, the bank trap, has closed. Now let's talk about the banks, because this is where things turn violent. At year-end, banks aggressively smashed silver prices. Why? Not because they were bearish, but because of regulatory pressure. They needed prices lower to clean up balance sheets, reduce reported exposure, and satisfy capital requirements. It was defensive, and it worked, for a moment. But then geopolitics hit, and silver ripped higher before they could reposition. That's how traps work. When price blew through the $75 level, something mechanical happened. Short covering stop losses triggered. Not emotionally, automatically. Algorithms began buying. Options dealers were forced to hedge. Gamma kicked in. Every dollar higher created more mandatory buying. This is the feedback loop banks fear most, because once it starts, it doesn't respect narratives, it respects risk limits. Now the banks are facing a prisoner's dilemma. If they all stay short together, they risk catastrophic losses. If one bank covers early, it survives and forces others into worse positions. So what do rational actors do? They defect, they buy, they run, coordination breaks, and when coordination breaks, suppression ends. This is why moves like this accelerate, not because of greed, but because of self-preservation. And here is the parts no one wants to say on financial television. Once banks flip from suppressors to coverers, they become fuel, not resistance. Force number 4, the January wave is just beginning. Now let's zoom out, because everything so far has happened before the real money arrives. January is not just another month. January is when institutional capital allocates. Pension funds, sovereign wealth funds, insurance portfolios. We're talking about tens of trillions of dollars. And after a disastrous 2025 for traditional portfolios, the 60-40 model is broken. Stocks are unstable. Bonds are radioactive. So capital does what it always does in transitions. It rotates into real assets. Here's where silver quietly dominates. These institutions don't say, buy silver. They say, climate transition, infrastructure, electrification, energy security. And what underpins all of that? Solar panels, electric vehicles, grid expansion, all of which require massive quantities of silver. So when pension funds allocate to green solutions, they are indirectly demanding silver, and that demand is sticky. It doesn't trade in and out. It removes metal from circulation. Most of that demand comes through ETFs, and ETFs require physical bars, which must come from vaults, which are already emptying. This is how a paper market breaks. Not from panic, from exhaustion. Why this is not 2011. Some people are already saying, I've seen this before. No, you haven't. 2011 was a speculative blow-off. This is a structural repricing. Back then, silver demand was optional. Today, it's mandatory. Back then, supply was available. Today, it's constrained. Back then, banks had room to maneuver. Today, they're trapped. And most importantly, in 2011, Shanghai didn't matter. Today, Shanghai sets the tone. This is a different market, a different world, and a different outcome. So where does that leave us right now? Silver has broken resistance. Banks are covering. Physical demand is accelerating. Institutional money is waking up. And geopolitical risk has added a permanent premium. The market is no longer asking if silver breaks higher. It's asking how fast. And that's where things get dangerous. Because the next phase is not smooth. In part 2, we were going to cover why the move from 75 to 85 is an air pocket, why volatility and halts are bullish, not bearish, why leverage is lethal in this phase, and how to manage a winning position without giving it back. Because getting silver right was the first battle, keeping it through the melt-up is the real test. Now let's talk about what comes next, because this is the phase where most people make their biggest mistakes. Not because they're wrong, but because they don't understand the environment they're in. The $75 to $85 air pocket. Between $75 and $85, there is very little technical resistance. Why? Because silver hasn't spent meaningful time there. No consolidation, no volume nodes, no established sellers. That zone is thin, which means price can move through it fast, not smoothly, fast. This is where markets don't climb stairs. They take elevators. Every dollar higher forces. More short covering, more options hedging, more ETF inflows, more arbitrage buying for Shanghai. It compounds. That's why the $85 level matters. It's not just psychological, it's structural. It represents the upper boundary of the old system. Once breached, the market enters price discovery. And price discovery is chaos, why volatility is bullish. Now, you're going to see violent moves, $3 up days, $4 pullbacks, limit up halts. This is not weakness, this is stress. In a healthy liquid market, price moves gently. In a stressed market, price jumps because sellers are gone. If silver was topping, volatility would be paired with distribution. Instead, we're seeing